Hello, my name is Hagen Harold and thank you for joining me for this presentation. I'm a third-year Bachelor of Commerce student at the University of Victoria and I've been completing the Applied Investment Management course as part of the Applied Portfolio Management program for the past 6 months. During this time, I've been analyzing Canadian Tire Corporation, and in my presentation I will be telling you why it is currently overvalued and should be sold. This is because the company's ambitious return on invested capital target, as well as the cyclical and risky nature of the brick-and-mortar retail business, warrant a high required return that is not currently reflected by the stock price. I'm going to start by giving a brief description of the various subsidiaries that make up Canadian Tire. By far the largest banner is Canadian Tire Retail, which makes up about 51% of the company's total revenue, followed by Sport Chek with 14% and Mark's with 9%. These brands are among the most recognizable in Canadian brick-and-mortar retail and are key players in their respective industries. Canadian Tire additionally operates a financial services division, which issues credit cards and offers savings accounts for its clients. Canadian Tire also is comprised of a real estate investment trust, which leases primarily to Canadian Tire retail stores, but also seeks opportunities for investment properties elsewhere. Finally, Canadian Tire Corporation operates gas bars, usually adjacent to their Canadian Tire retail stores, and last year completed the acquisition of Helly Hansen, an outdoor wear firm that not only strengthens Canadian Tire Corporation's position in this industry, but also gives them access to Helly Hansen's European distribution streams. Overall, Canadian Tire Corporation ranks 7th in terms of sales across all retailers in Canada, capturing about 6% of the market. This demonstrates how ambitious their goal of being the #1 retail brand in Canada by 2022 really is, as the industry is highly competitive and prices are facing increasing downward pressure as competition intensifies, especially from online retailers. The brick-and-mortar department store industry has been in decline since 2005 and is projected to continue to decline, posing a major threat to Canadian Tire Corporation. On top of the declining nature of the industry, CTC faces several other risks. The cyclical nature of the retail industry makes CTC especially vulnerable to a decline in consumer spending and disposable income, as these drive sales. Other risks include sourcing, as has been the case with recent COVID-19 developments, as shipments in January were set back as a result of shutdowns. Canadian Tire operates in Shanghai as well as other locations in Asia, which made it particularly susceptible to shutdowns. Trends towards e-commerce as well as consumer taste in the apparel industry are additional risks to CTC, as well as seasonality, due to the large number of seasonal products sold by Canadian Tire. Lastly, credit risks are a danger to CTC, as the high debt load of the Canadian consumer could lead to defaults on credit card loans if there was a sudden spike in interest rates. Because of the large debt load of the financial services division, CTC has relatively poor consolidated leverage ratios compared to its competitors. However, the retail division of the company is actually net cash when accounting for intercompany debt, and this should be noted when comparing CTC to other retailers in terms of leverage. Since 2015, CTC has been posting consistent top-line growth driven by strong comparable or same-store sales growth. This has been the result of continuous investment in owned brands. However, margin and bottom-line growth has not been growing at the same rate. This has led the company to introduce a new operational efficiency program which seeks to retire legacy equipment and eliminate duplicate processes to continue to grow the bottom line as well. The company's retail return on invested capital is one of its biggest performance benchmarks, with the company aiming for a 10% ROIC. While this will most certainly not be achieved this year, my projections see this target being achieved by 2024, which is still far behind schedule. CTC's forward multiples are currently benefiting from its lower than usual stock price. It is currently trading far lower on price earnings and enterprise value to EBITDA due to the lower stock price, but it is earning a far lower return on its equity than its competitors, and its share repurchase program is additionally influencing its price earnings ratio, as its earnings per share are higher than its competitors due to its lower number of shares outstanding. For these reasons, Canadian Tire Corporation's stock price has been in decline for the last 2 years, with the impact of COVID-19 resulting in a drastic decline over the last few months. To determine my target price for the stock, I have projected 3 different scenarios onto a discounted cash flow model of CTC's earnings. The assumptions made for these scenarios are a capital expenditure ratio of 25% to EBITDA based on historic rates. A 10% discount rate was applied to incorporate the cyclicality of the industry as well as the ROIC target set by the company. The stock price was then determined using both a terminal growth approach and an approach using enterprise value to EBITDA to determine the terminal value. The bull case assumes that despite the current shutdown of stores, online sales will continue to allow for growth at CTC's banners as curbside pickup and deliver to home become more viable for customers. This results in a 2.8 annualized percent growth rate year over year. The base case scenario involves a significant decrease in sales for the current year due to COVID-19. This is followed by a significant rebound, as was evident in 2010 following the last major recession. This is followed by an annualized growth rate of around 2%, resulting in a stock price range of $68.62 to $78.52. Lastly, the bear case scenario assumes a large decrease in sales for the current year, but following this year assumes no recovery as the lasting impact of the coronavirus on the economy results in reduced sales and a continued decrease in revenue at CTC. By weighting these stock prices according to their probabilities, a target price range between $62.85 and $73.41 is generated, indicating that CTC's cash flows are far overvalued by the current stock price, resulting in a sell decision. As for the company's management track record, I will focus on their ESG integration to evaluate the company's track record. Canadian Tire's environmental targets include a 22% emission reduction target between 2011 and 2030, as well as flat transportation-related emissions compared to 2011 levels. The company is also working to reduce waste through rigorous quality assurance methods that have reduced product defect margins by 11 basis points. CTC is also engaged in a variety of social programs, the most prominent being Jumpstart, which was started by CTC's majority shareholder, Martha Bills. The program provides financially struggling families with funds for their kids to participate in sports. Lastly, CTC's governance has been criticized for its lack of shareholders' rights, as only 3 of the 16 board positions are voted on by holders of non-voting Class A shares. This is problematic as 60% of common shares are held by Martha and Owen Bills, the daughter and grandson of CTC co-founder AJ Bills. This gives them a majority of the vote for 13 director positions, resulting in low governance scores on ESG ratings. As for its compensation, CTC pays its CEO far more than its other named officers. In comparison with benchmark Canadian companies listed by CTC, it pays far more than companies with comparable market caps. This additionally shows why governance is rated among the lowest factors of CTC's ESG score. As for the rest of the portfolio allocation, my buy recommendation is Canadian Pacific Rail due to its position as one of the 2 largest rail companies in Canada. This industry is nearly impossible to enter due to the lack of infrastructure, and while it requires high capital investment, it also yields high returns, as is evident by the high return on equity that CP Rail enjoys. This justifies its high price and price earnings ratio compared with other companies in the Applied Investment Management course portfolio. Therefore, it is one of the most stable and profitable companies, which is why I recommend it as a buy. Thank you for listening to my presentation, and please do not hesitate to contact me if you have any questions.